Every successful Forex trader knows one thing: profits don't come from prediction, they come from risk management. And at the heart of that is a concept every trader must master: risk versus reward. Understanding this balance can mean the difference between a short trading career and long-term, consistent success. Let's break it down. First, what is risk versus reward? In simple terms, it's the ratio between how much you're willing to lose and how much you aim to gain in a single trade. For example, let's say you risk $100 to make $300. That's a 1-to-3 risk-to-reward ratio, meaning for every dollar you risk, you expect to earn 3 in return. This ratio helps traders stay consistent because even if some trades lose, the winners can more than make up for it. It's not about winning every trade. It's about making sure your rewards are bigger than your risks. Second, why it matters. The Forex market is unpredictable. Even the best setups can fail. That's why professionals don't aim for perfection. They aim for positive expectancy. Here's how it works. If you have a 50% win rate with a 1-to-2 risk-to-reward ratio, you'll still make money over time because your average profits outweigh your average losses. In other words, you don't have to be right every time. You just have to manage your risk better than you lose it. Third, how to calculate it in practice. Before placing a trade, ask 2 questions. Where will I enter? Where will I exit? Both for profit and for loss. Your stop loss defines your risk, and your take profit defines your reward. Example, if your stop loss is 50 pips and your take profit is 150 pips, your risk-to-reward ratio is 1-to-3. That means you can lose twice and still come out ahead on the third trade. Professional traders think in terms of probabilities, not emotions. Fourth, the psychology behind it. Many traders lose money not because their analysis is wrong, but because their risk control is weak. They move stop losses, double down on losing trades, or close winners too early out of fear. The key is emotional discipline, accepting that losing is part of trading. If you respect your stop loss and stick to your plan, you protect your capital and keep yourself in the game long enough to catch the profitable moves. Remember, in Forex, survival equals success. Fifth, building your strategy around risk and reward. Smart traders design their strategies with the ratio first. Most professionals aim for at least a 1-to-2 or 1-to-3 ratio, risking less to gain more. But ratios alone aren't enough. You must also manage position sizing, use proper leverage, and avoid overexposure in volatile markets. Your ultimate goal isn't to win big once. It's to grow consistently over time. In summary, understanding risk versus reward isn't just about math. It's about mindset. It's the foundation of every professional trading plan. It teaches discipline, patience, and smart decision-making. So before you think about how much you can earn, ask yourself, how much can I afford to lose? Because in Forex, managing your risk is the first step toward managing your success.